Good afternoon. This is Mike Bertelson, the Bear Market Investor, the market update for February 25, 2011. We're here looking at the S&P 500 stock index and the Volatility Index, doing our weekend video update. Now let's go ahead and look at the 15-minute time frame here of the S&P 500. On Friday, February 18, 2011, it looks like under our best Elliott wave count interpretation, we may have put in the top tick in an ABC correction from the March 2009 lows. In the prior video that I did lay out three different bearish cases from the Elliott wave count perspective. Two of them would have us moving below the March 2009 lows. The third would not have us take it out, but instead we would be working a grand supercycle wave 4 triangle. Please see my prior video for more information on any of those counts. Now from this top that we put in, so far so good. It looks like we have a 5-wave push to the downside. That we have wave 1 down, wave 2 up, wave 3 down, wave 4 up, and then wave 5 down. The 5 waves down, assuming that we're not in some complex correction, suggests that the trend has changed from up to down, but we are going to need further confirmation of that. In the direction of the trend, you should always see 5-wave pushes. It can also extend beyond 5 waves, but we're looking for a 5-wave push. We got the first small 5-wave push here, but 5 waves can also be part of an A wave as well. So, we need to see 5 larger waves put in to the downside. Okay? So this would be wave 1 right here. And that we're working on wave 2. That we should see wave 3 erupt in a very, very strong sell-off to the downside that will eventually take out that wave 4 of 5 of C that I've discussed in the prior videos. Now, from this counter trend bounce bottom here, it looks like we are in process of carving out a double 3. A double 3 is where you have an A wave here, a B wave, a C wave, an X wave, an A wave, and then in this case a B wave triangle. And that we will see a C wave push to the upside. In my YouTube channel on Friday morning, I had suggested that based on this wave structure here at right about this time, it looks like we could have completed that counter trend bounce. But we did sell off, find support, and then move on higher again, suggesting, of course, the counter trend bounce is not finished yet. Now, my ideal ending point here for this, as I laid out in the prior video, was not this 50% retracement, although that has met a minimum guideline for a wave 2. It would be that we would move into the 61.8% Fibonacci right here, which also happens to be the bottom of this wave 1 down of 3, or perhaps as high as the 78.6% retracement, or even a little bit higher. But we really don't want to see a convincing push through this last peak right here, this last minor high at this point. We don't want to see a gap fill here either. At any point where we get a push well beyond the 78.6% retracement, then we have to have a really good reason to believe that the wave structure suggests we're in a counter trend bounce or in a correction. Okay? Deep retracements can happen in either a B wave or a second wave, but generally you don't like to see them push beyond that 78.6% retracement. Pushes beyond that 78.6, maybe even the 80%, are not good for the bearish perspective here. So we want to see this thing end sometime soon. Now let's go ahead and jump into that 2-minute chart, and I'll show you more information on the short-term counter trend bounce. We're looking at the 2-minute chart here of the S&P 500, and what I want to show you is why I believe we're in a double three correction from the February 24 low. Now we had the top of a wave A here, wave B. We had a wave C complete here. We had an X wave. We had an A wave. We had a B wave triangle that we're still in process of carving out, assuming it has not completed after the market closed or before it opens on Monday. Now we should see an E wave down in this triangle, followed by a thrust to the upside, I believe, in a breakout of the B wave triangle, and hopefully finishing up a C wave of a double three correction. That we want to end in that 1325 to 1335 area. If we go beyond that 78.6% retracement, then we really want to be cautious. There could be a misreading of wave structure at that point. And that's why we darn well better be sure that it's a counter trend bounce if you're not stopping yourself out. So, we are looking for a small push down again on Monday, assuming it didn't already complete, and that we will have a thrust to the upside, probably pushing through this yellow trend line right here that we've been straddling this entire time. Once we see that, we should enter into a third wave to the downside. That should be a very strong sell-off. Once we have this counter trend bounce in place and begin that third wave, we'll take a look at that wave structure and see what things look like. Ideally, we want that third wave to the downside to break through that wave 4 of 5 of C low. That helps confirm that a longer term reversal is in fact taking place. But we're not quite there yet. Again, as I've noted, we want to take out the last major low. That major low came from the April 2010 sell-off. Okay? Once we take out that low and have a larger 5 waves to the downside put in, then we can be much more confident in the longer term reversal taking place. So that's what we're expecting at the moment. And as I'm going to show you in the Volatility Index, the Volatility Index suggests that we will see a little less volatility, at least at some point on Monday, before the real volatility enters into the market again. Now we're looking at the daily time frame of the Volatility Index, and what I think may happen on Monday is that we could see a test of gap support accompanying a small C wave to the upside in that double three correction that I believe we're in from the bottom that we had on February 24 in the S&P 500. And from there, we would want to see a surge to the upside. Now, it is possible that we may come back to test this ascending area of support if we had a very deep retracement. But as I've noted, we don't want to see a very deep retracement. We can see perhaps up to that 78.6% retracement, but I think beyond that starts to worry me. Now, ultimately what needs to happen on the Volatility Index is we need to break the 78.6% retracement on the Fibonacci fan here in blue. We also need to see a break of that longer term declining area of resistance. As I've noted, that 78.6% retracement of the Fibonacci fan and that declining resistance trend line match up identically, and I don't think that's any coincidence. This is the type of thing the market does. This is the way market psychology works. After we get a thrust through that closes above it, we could see a back test, but we want to see a convincing thrust to the upside from there. Now, I don't know if a third wave to the downside that we're expecting to happen and the S&P 500 is going to do that or not. But seeing this break convincingly, even if we get a back test and a thrust above that, putting in a new high, that is going to ultimately turn me very, very bearish on the market, suggesting that we have a pretty strong indication the trend has turned from up to down in the S&P 500. Okay, so do look at my prior videos if you want a larger perspective on the volatility index and the S&P 500. I've laid out a number of possible scenarios there, one that could even have us hold up in the S&P 500 or move higher through the middle of the year, looking at the volatility index. However, using the count that we have in the S&P 500 and the fact that so far things are playing out as we would like to see them play out, it does suggest that we may not see the volatility index continue to trend sideways through the middle of the year, and that we should see an eventual surge here through these areas of resistance. In any case, I will plan to make a video early on next week. If you wouldn't mind rating the video, I would appreciate it. Have a great weekend.